What was the Plaza Accord? Japan's lost 30 years began here. In the 1980s, Japan was at the height of its economic power. Japan as number one, that phrase was no exaggeration. Exports were booming, industries thriving. But in 1985, an international agreement signed in a New York hotel would trigger a chain of events that drastically altered Japan's economic trajectory. That agreement? The Plaza Accord. Today, we'll explore how this deal reshaped Japan's economy, and how it ultimately led to what we now call the lost 30 years. On September 22, 1985, top financial leaders from 5 nations, the United States, Japan, West Germany, France, and the United Kingdom, gathered at the Plaza Hotel in New York. Their goal? To bring down the overvalued US dollar. At the time, the US was facing massive trade deficits, especially with Japan. The strong dollar made American goods expensive, while Japanese products, especially cars and electronics, flooded the US market. To fix this, the US called for international cooperation to weaken the dollar through joint intervention in currency markets. Thus, the Plaza Accord was born, an agreement where each country committed to selling US dollars and buying their own currencies, in an effort to manipulate exchange rates on a global scale. Following the agreement, the yen soared. Within just 2 years, the exchange rate shifted from 240 yen per dollar to 120 yen, doubling the yen's value. For Japan's export-dependent economy, this was devastating. A Japanese company selling $10,000 worth of products overseas saw its revenue drop from 2.4 million yen to 1.2 million yen overnight. Profits shrank. Red ink appeared across balance sheets. Thousands of small and mid-sized exporters went bankrupt. Job losses mounted. To survive, many Japanese firms moved production abroad, triggering the first wave of industrial hollowing out in the country. To combat the yen shock and economic slowdown, the Bank of Japan launched a series of aggressive monetary easing policies. From 1986 to 1987, the official discount rate was slashed from 5.0% to 2.5%, a record low. The government encouraged domestic demand to offset export losses, and made it easier than ever for businesses and consumers to borrow money. But here's the problem. Rather than reinvesting in production or innovation, companies and individuals pour this easy money into real estate and stock markets. Thus began Japan's descent into the asset bubble era. From 1987 to 1989, Japan was riding high on an economic miracle. Land prices in Tokyo skyrocketed. It was said that the land within the Yamanote train line was worth more than all of the United States. In December 1989, the Nikkei stock average hit a historic peak, 38,915 yen. Speculation ran wild. Land will never lose value. Stocks will only go up. This unshakable belief created a false sense of invincibility. Banks issued massive loans using land as collateral, and companies doubled down on real estate investments. It was a fragile house of cards waiting to collapse. In 1990, the government finally acted to cool the overheating economy. Japan's Ministry of Finance imposed the real estate lending cap, a policy restricting banks from increasing their real estate lending beyond the previous year's levels. Suddenly, the flow of money into property markets froze. Real estate prices plummeted. Stock prices followed. The collapse was swift. Companies fell into debt. Banks drowned in non-performing loans. In 1997, the once reputable Yamaichi Securities shut down. Public trust shattered. The myth that big corporations never fail was destroyed. And so began Japan's prolonged economic stagnation, what we now call the lost 30 years. The Plaza Accord was a rare attempt at global currency coordination, but its aftershocks devastated one of the world's strongest economies. Rapid currency appreciation, misguided monetary policy, and an unsustainable asset bubble. These factors turned Japan's economic miracle into decades of stagnation. Today, as the world once again faces volatile markets, we must ask, what lessons have we learned? How can we avoid repeating the same mistakes? Understanding the Plaza Accord isn't just about history. It's a warning for the future. A single international agreement reshaped a nation's destiny. The Plaza Accord was more than a currency deal, it was a turning point. Thank you for watching. If you found this video helpful, please like, share, and subscribe to our channel. See you next time.